Hello, good morning, everyone. Welcome to Phillip Securities Research Morning Call for 13th of March 2023. We have quite a few stock counter and technical analysis updates for today. And as usual, we will end the session with Singapore Weekly. Without further ado, let us get started with Salesforce fourth quarter results. Salesforce is basically a software company, and its products helps companies to manage their customer relationships as well as to boost their sales. Overall, their full year 2023 revenue was at 101% of our forecasts, while adjusted PATMI was higher than expected at 106%, mainly because of higher operating leverage. In the fourth quarter, Salesforce reported a revenue of 8.4 billion, while net loss of 98 million. Net loss increased mainly because of higher losses on strategic investments and higher taxes. The company reported adjusted earnings per share of $1.68, and this is after excluding stock-based compensation expense as well as amortization of purchased intangibles. So moving on to positives, first of all, total revenue, it grew by about 17% year over year in constant currency. And this was mainly driven by strength in its Tableau and MuleSoft license sales. Also, the core products, Sales Cloud and Service Clouds, they were resilient as its revenue, they grew by about 13% year over year. Meanwhile, the remaining performance obligation, which is a metric for the near-term demand, it grew, and remaining performance RPO, it basically means that the revenue that have been contracted but not yet delivered, it grew by about 11% year over year to 48.6 billion. Secondly, Salesforce reported a record high operating margin in the fourth quarter of about 29.2% as compared to 15% in the year ago period. And this is mainly because of higher operating leverages across all its cost line items, and particularly research and development, which fell by about 13%. And additionally, this is driven by job cuts. In January 2023, the company, it reported a 10% job cut, and this resulted to a one-time benefit of about 1.5 percentage points. Moving on to the negative, Salesforce, it faced pressure from foreign exchange headwinds. The company, this is important mainly because the company generates about 30% of its revenue from international markets. And as a result, it had a negative impact of about $250 million on the fourth quarter total revenue. Additionally, the company projects a 150 million headwind in the first quarter of 2024. So moving on to the outlook for the first quarter 2024 as well as for full year 2024, the company, it expects a revenue growth rate of about 10% with $34.6 billion at the midpoint for the full year. And the company, it said that it expects no significant impact from foreign exchange headwinds for the full year. Then the company, the management, it noted that it expects to witness a higher sales, longer sales cycle, as well as deal size compression this year. And it expects adjusted operating margin of about 27%, which is led by job cuts and real estate consolidation. In terms of its bottom line, the company expects adjusted earnings per share to be in the range of $7.12 to $7.14. In terms of its valuation, we have lowered our full year revenue by 2%, mainly because of slowing demand environment, whereas we increased our adjusted PATMI by 24% due to lower expenses. So as a result, our DCF target price was increased to $219 from the previous $205, with a weighted average cost of capital of 7% and a terminal growth rate of 4%. So that's all for Salesforce. I would now like to pass on to John for C Limited earnings.
Thanks, Ambrish, and good morning, everyone. So for today, we'll be covering C's fourth quarter 2022 results. And we issued a report titled The First Profitable Quarter. Next slide, please. So just a snapshot for the fourth quarter of 2022, revenue actually missed our expectations slightly due to continued weakness in its gaming revenue as well as some FX headwinds. However, net income actually beat by about $1 billion, mainly due to a significant reduction in overhead costs and expenses. For fiscal year 2022, revenue was at 96% of our forecast, with net loss 1.2 billion above forecast. So for C, the two main positives, obviously the biggest thing from the whole call is that they were actually profitable for the first time in a quarter. Revenue actually grew. There are several reasons for this. The first reason was revenue actually grew about 7% year on year, led by Shopee, which is its e-commerce division or business. They also saw improving logistics efficiency, which reduced costs by about 8%. But the biggest thing that they saw for the quarter was a 61% cut in sales and marketing expenses, and this was communicated in its third quarter earnings call as well, when they mentioned that it was going to look towards being profitable earlier rather than later. I guess a subset of this is that Shopee, which is its e-commerce platform, was profitable for the first time, and this comes even as GMV, which is gross merchandise value, and gross orders declined 1% and 15% year on year. So they saw I guess for GMV volume was about the same as last year, but gross orders, 15% is a significant decline in gross orders. How they managed to do this was they actually increased their take rates, which is their I guess commission from each transaction that you make on Shopee. So they rose take rates by several percentage points year on year. At the same time, they also reduced their sales and marketing expense by 55%. So this led to a operating income of $109 million for the fourth quarter. In terms of the negative, similar to the last quarter, Garena, which is its digital entertainment business, continued to weaken. Revenue was down 33% year on year, and this was mainly due to not just company specific, but industry specific decline in user engagement across the gaming industry. So you can see that QAU, which is quarterly active users, and quarterly paying users were down 26% and 44% respectively. One of the main reasons for a significant decline in users is because Garena doesn't really have a very strong, I guess, self-published or self-developed gaming pipeline. So right now, it really relies quite heavily on its number one game, which is Free Fire, which is a mobile MMORPG game, and mobile only. And so, this game has already been in existence for more than 10 years, and usually after a few years, you start to see some, I guess, negative headwinds in terms of growth. People start getting disinterested with the game, and that's kind of what is happening for Garena right now. In terms of the outlook, so we expect to see Shopee and C-Money, which is Shopee's e-commerce, C-Money is its digital financial services. We expect to see these two segments actually start to support revenue growth moving forward, especially as digital entertainment starts to decline. C-Money is actually pretty helpful. It creates a lot of synergies with Shopee because it kind of helps to reduce a lot of friction in terms of transactions when people buy stuff on Shopee. At the same time, they're also improving the quality of its loan book. So right now, C-Money has about $2 billion on its loan book. And that's one of the other ways that they're able to generate revenue for that segment. In terms of our valuation, we actually cut our fiscal year 2023 revenue by 20%, mainly due to a continued decline in gaming. And we also factor in slightly slower e-commerce growth for this year. However, we did increase PATMI and EBITDA by 1.2 billion and 700 million to reflect improving profitability and some operating leverage especially in the e-commerce business. We maintain a buy rating with a raised target price of $120, up from $110 US dollars previously. So that's all for C. I'll now move on to TDCX. Next slide, please. So we'll be running through TDCX's fourth quarter results with the title Near-Term Pain Expected. So just a brief overview, TDCX is a outsourcing service company. So they specialize, two of their main business segments are outsourcing omni-channel customer experience. So most of this is like your call centers and stuff like that. And the other segment that they have, which is fairly large, is their sales and digital marketing segment. So what they do there is they provide sales and digital marketing services for companies to like market their products, or rather to market their products in an outsourced fashion. In terms of their fourth quarter results, results were roughly in line with our expectations, with fiscal year 22 revenue and PATMI at 100% and 97% of our forecast. Earnings were hurt slightly due to a 6 million Singapore dollar FX loss on cash and receivables. In terms of some of the positives, digital advertising continued to show a lot of strength, and that actually boosted revenue growth. So digital advertising vertical saw double-digit year-on-year growth for the quarter, and it's quite large because it represents 54% of total revenue. At the same time, net revenue retention, which is essentially your churn of existing clients. So this number was at 117%, showing that indeed there's quite a strong pipeline of existing, a strong revenue pipeline from existing clients. In terms of the other positive, we're starting to see expansion that so the company actually expanded into 7 new geographies over the last 2 years. And we're starting to see this bear fruit a little bit more now. New clients contributed about 10% of total revenue growth for 2022. And another plus side for this is that the revenue concentration risk also decreased. So previously, the top 2 clients made up about 59% of total revenue. This number has now come down to about 52% as a percentage of total revenue. So it helps because the company will be a bit less reliant on its top 2 or top 5 biggest clients. If any of them had any adverse news or I guess revenue contractions. Important to note that new geographies and new clients actually take about 2 to 3 years to actually contribute meaningfully. This is usually the case because a new client will start very small in terms of headcount and seats with TDCX, and then as the company performs, delivers a strong performance, then the clients start to add and compound onto this. So this usually takes, given that the contracts are at least yearly in nature, it takes a little bit of time for it to start going. In terms of the negatives, TDCX actually delivered quite soft revenue guidance for 2023, as well as adjusted EBITDA margin guidance. Revenue guidance came in at about 3 to 8% year-on-year, and this was significantly impacted by, I guess, a volatility and limited visibility of its clients. So actually, a lot of their clients, and these are mainly your new economy big tech guys. They began cutting their headcount requirements, and so the first thing that also goes will be all these outsourced expenses in the near term. At the same time, there's also this expectation that volumes from the digital advertising vertical will flatten for this year, which, I mean, given that it's such a big component of total revenue, it did place quite a big drag in terms of why the company guided to only 3 to 8% revenue growth. In terms of adjusted EBITDA margins, margins for 2022 was about 30%. They expect 2023 to have adjusted EBITDA margins of about 25 to 29%, slightly low. A couple of reasons for this. The first was they actually did overhire in anticipation of higher volumes for this year. Number 2, as they expanded, they had to hire a lot more upper management and more quality management staff to oversee these new geographies. So this kind of placed more headwinds on margins. And lastly, they did also, or they are also investing in some technology I guess some AI technology and stuff like that to improve business processes that are, multi-year commitments. So all these are a little bit more sticky in terms of its nature is very difficult to cut. And that's why the adjusted EBITDA margins were a bit lower. In terms of valuations, we cut our fiscal year 2023 revenue and EBITDA by 8% and 16% to reflect the ongoing macro challenges in digital advertising. But we do still believe that TDCX has a very healthy cash generative business. We do also expect longer term tailwinds from an expanding BPO market is still intact, especially in Southeast Asia, where most of TDCX's revenue comes from. We maintain an accumulate rating with a reduced target price of $12.10, down from $14.80. So that's all for me. I'll hand it over to Glenn for Singapore Banking Monthly. Thank you.
Thanks, John. So for the Banking Monthly, I think I'll first touch upon the first topic, which is on everybody's minds now, which would be the collapse of Silicon Valley Bank. So just a brief background of what happened. So on 8th March, Silicon Valley Bank announced $2.25 billion capital raising exercise. And this is following losses on the sale of securities as it needed to fund customers' deposit withdrawals. So the customers reacted by attempting to withdraw around $42 billion of deposits. And on 10th March, SVB was closed and it was taken over by authorities due to inadequate liquidity and insolvency. So there's a recent new update which mentioned that the Federal Reserve will be ensuring that customers' deposits are secure and they are able to withdraw it. However, this only applies to customers' deposits and not to shareholders or unsecured loans. So just why would this be important for Singapore banks? We'll be doing a quick run through on the differences between what happened at SVB and comparing it to our local banks here in Singapore, namely DBS, OCBC, and UOB. So firstly, the first one would be that SVB had a very large concentration on securities. So we can see from the top, the red box here, SVB had about 57% of its assets in securities, and the majority of it is in government-backed securities. And as the interest rate started to rise, bond prices fell sharply, and this caused a decline in SVB's securities portfolio. So when purchasing securities in the US, banks are able to decide upfront whether they intend to hold them to maturity, and they designate these securities as held to maturity or available for sale assets. So the key difference being that the held to maturity assets are not marked to market, while the available for sale assets are marked to market. And as at 31st December 2022, SVB had $15.2 billion of unrealized losses on their held to maturity securities, which makes up about around 93% of their total equity. So in comparison with the three local banks, they only hold securities amounting to around 15% of assets. And while Singapore banks also faced bond losses, they were less significant, as majority of the assets were variable rate loans, where they could pass on the higher interest rates directly onto their customers. Now moving on to my next point. Yeah, my next point would be that, yes. So another point would be SVB's assets grew much faster than the Singapore banks. So it almost tripled over the 3 years, and it grew at a CAGR of 44% over 3 years, while deposits grew at 41% over the same period. And this was mainly due to the rise in venture capital funding during the pandemic, and many of their customers were suddenly flush with cash. However, with the loan demand weak for SVB, they channeled the majority of these fresh deposits into securities portfolios or kept it as cash. And as the interest rate started to rise in the second half of 2022, the losses on the securities portfolio started to appear. If you look at Singapore banks, their growth rate of both their assets and deposits were much more stable and much lower. So it grew at a CAGR of 6.9 and 6.7% over 3 years. Their focus for the Singapore banks were kept on loans growth. So that's one of the big differentiators, with the loan to deposit ratio kept high at 83% and CASA ratio at 53%. So again, with the rise in interest rates, Singapore banks were able to pass on the higher funding costs directly to the customers. Now, on to my third point regarding the liquidity coverage ratio. So as a general rule of thumb, the interest rate risk is usually overseen by the regulators and the central banks through the liquidity coverage ratio. And there's this requirement for the banks to hold enough high quality liquid assets, which can be sold during this kind of scenario. However, in SVB's case, they were never subjected to the Federal Reserve's LCR requirement, as they did not meet the minimum requirements of at least $75 billion in non-bank assets. And this meant that when their customers started to pull out deposits, they were unable to withstand the deposit outflows. But if you look at Singapore, all three local banks are required by MAS to meet the minimum LCR requirements of 100% for both all currency and SGD. And the Singapore banks currently have LCR of around 144% as at 31st December 2022. This means that they will most likely be able to withstand a surge in deposit outflows in a worst case situation. Now, for my last point, this is more of a point regarding the common capital ratios. So interestingly, we can see that SVB's Common Equity Tier 1 or CET1 ratio of 12% is similar to that of Singapore banks at 14.4%. And SVB's leverage ratio of 13.2 times is also higher than Singapore Bank's leverage ratio of 11.6 times. Okay, now let's move on to the Singapore highlights. Yeah, so for the banks, the three local banks recently released their fourth quarter results, and just a brief update on their results. Firstly, their net interest income rose 55% year-on-year as the NIM improved by 69 basis points, but with slower loans growth of 2%. And the NIM improvement was mainly due to rising interest rates, as the impact of the interest rates hikes were more fully felt in the fourth quarter. And for FY23, the banks are guiding for NIMs of 2.1 to 2.25%. The loans growth guidance is maintained at a mid-single digit for FY23. However, there was a continued decline in fee income, and it declined 20% year-on-year. This is mainly due to lower wealth management fees as customer activities were more subdued amidst risk of investment sentiments globally. However, this was slightly offset by an increase in card fees. Sorry, I forgot to add this part here, but fee income is expected to increase by more than 10%, a double digit this year in FY23, as it's coming off a very low base in FY22, and there's expected to be a recovery as well as the economy starts to reopen, as well as with China's reopening. The credit cost has also improved across the board, and FY23 provisions guidance for the banks have been either maintained or lower. The CET1 ratio of 13.3 to 15.2% is still above the operating range of 12.5 to 13.5%. Now moving on to Singapore interest rates. So the interest rates continued to flatten and slow down in February. The 3-month SORA was up 16 basis points month-on-month to 3.21%, while the 3-month SIBOR was down 4 basis points month-on-month to 4.21%. The SORA month-on-month increase was an improvement from the 3 basis points decline in January, but this is still the smallest growth recorded since May 2022. And the SIBOR month-on-month decline was the first decline since September 2020. February's 3-month SORA improved by 298 basis points year-on-year, while the February's 3-month SIBOR improved by 374 basis points year-on-year. Moving on to the next slide, we can touch on the loans growth. Yeah, so for Singapore loans growth, it continued to decline in January, and the overall loans fell by 1.89%, and this is below our estimate of mid-single digit growth for 2023, as the rise in interest rates started to be more fully felt by the consumers. For the business loan segment, it fell by 2.91%. And however, there was a slight uptick in the loans to the business and building and construction segment, which is the single largest business segment, and it rose by 0.62% year-on-year. However, the loans to the manufacturing segment fell 8% year-on-year. For the consumer loans, it was down, but down slightly, almost flat, at down 0.22% year-on-year, as the dips in the other segments were slightly offset slightly by strong loan demand in the housing segment, which makes up about 70% of consumer lending and grew 3.28% year-on-year. For the deposits, the total deposits and balances grew by 5.9% year-on-year, but there was a continued dip in the current accounts and savings accounts proportion to 20%, and this is down from 20.4% in December, as there was a continued move towards fixed deposits due to the higher interest rate environment. For Hong Kong loans, the Hong Kong domestic loans growth declined 2.5% year-on-year, but rose 1.26% month-on-month in January. And the decline in year-on-year decline in January was lower than the decline of 2.99% in December. Now moving on to the SGX market statistics. So the preliminary SDAV for February fell 33% year-on-year to 1,094 million, as the market sentiment remains subdued at the start of 2023 due to macroeconomic factors. The VIX averaged 20.1 in February, and this is down from 20.2 in the previous month, while the DDAV rose 6% year-on-year to 1.08 million in January. The top 5 equity index futures turnover saw a dip of 2% year-on-year in February to 12.99 million contracts, and this was mainly due to the lower trading volumes of its Nikkei 225 index futures and the Nifty 50 index futures. Notably, the FTSE Taiwan index futures grew 8.1% month-on-month, and the Nikkei 225 index futures dipped 14.1% month-on-month. So now moving on to the last slide. So we maintain overweight on and remain positive on the Singapore banks. The bank dividend yields are attractive at 5.7%, with possible upside surprise due to excess capital ratios, as well as a push towards higher ROEs. Singapore banks also differ from Silicon Valley Bank, as majority of the assets are in loans and higher interest rates can be passed on directly to customers. So that's all I have for the banking sector. I'll now hand it over to Zain.
Thanks, Glenn. Good morning, everyone. So now I'll go on to the technical analysis section. Okay, first I'll talk about the S&P 500. So for S&P, we actually had a pullback last week, and then we actually retested this key downtrend resistance line over here. So currently, this is also the 50% Fibonacci retracement level at about 3,843. When we take the swing low of the lows in October of last year and the highs in February this year. Over here, if we find some support, we're able to do a bounce to the resistance zone over here, where it's about at 3,930 to about 4,020 area over here. We also have this downtrend resistance line that's currently acting during this pullback as well. For the support zone, if this 50% level fails to hold, we might go a bit deeper to maybe 61.8% retracement level. That's about at 3,760 level over here. Okay, then amidst the SVB collapse, we'll take a look at the regional banking ETF, which is this KRE. There's actually potential continuation of the downside when you look at the chart. So this is the weekly chart. So we have this bearish head and shoulders pattern over here, as well as a consolidation wedge. And last week, that we actually had a breakdown that occurred over here, which went below the $57 neckline over here. So the projected target, if based on the head and shoulder, right, we could be looking at a target of about close to $37 over here, which is the support zone over here at about $36.30 to about $40.30. So that currently represents a possible further downside of about 25% over here if we were to reach this current target. And if there's currently a bounce back to the resistance area over here, that will currently be about a 6% upside for now. Okay, then we look at the financial sector ETF, which is XLF. We also had a breakdown of this rising wedge pattern over here that took place last week. And this was after we actually touched onto this downtrend resistance line over here. So similar to KRE, there's possible continuation of the bearish momentum with this breakdown. So we could be looking at eventually hitting the support zone about close to $28.40 to about $30 over here when we take the projected target of the wedge breakdown. So this will coincide with a 50% Fibonacci retracement level at $28.70 when we take the lows from the COVID lows at about $16.55 to the highs at $40.84. So from the current price level of $32.93, that will represent about 10% possible downside to reach this target. And currently, if we were to pull back, do a bounce in the into the resistance zone, that will be about a 5% bounce. Okay, then when we look at the big four banks in the US, which are JP Morgan, Wells Fargo, Citigroup, as well as Bank of America. When we look at our charts, they're also showing some form of weakness inevitably. So for JP Morgan, there's also this rising wedge breakdown that took place last week over here. So it could actually head down to the support zone at about $122 to about $128. The $122 level is a confluence of 50% Fibonacci retracement level when we take the lows at about 100 over here and the highs at 144. So there's actually a possible downside of about maybe 7% from the current price levels at $133.65. If we were to retest the wedge over here, that would probably be about a 3% bounce to be expected. Okay, then moving on to Bank of America. Similarly, we also have this wedge breakdown that took place over here. So this was a triangle wedge. So could be looking at eventual target of about 23.50 to about 26.20 in this support zone. So this will also be confirmed for 78.6% retracement level at the $23.58 level when we take the lows of during the COVID lows at about $16.76 and the highs at about $48.65. So but currently price is holding at about $29.10 level, which was a key swing low that we tested twice and we found support. So if price fail to hold at this level this week, right, we could be looking at about maybe 18% further downside. But if price holds when we do a bounce, probably about 8% upside for now. Okay, then moving on to Citigroup. Citigroup is currently one of the stronger ones for now. Last week, it still managed to retest this $52.60 key resistance, which it rejected twice in May and August of last year. So for now, it's still also holding above this trendline support over here. So, but we still have to watch out for potential breakdown if it actually occurs. So if that happens, we could be looking at it going to the first support level at about $42.50 to about $47 about over here in the first support zone, and then subsequently about $35 to $39.20 in the second support zone over here. So if we were to break down for now, I would say the potential upside and downside is about relatively the same, about 4% either side for Citigroup. Then last but not least will be Wells Fargo. So Wells Fargo, we're still hanging by a thread over here. We actually retested the rising wedge support over here last week. Then there was a lower week being formed. So we shall see whether this week we're able to find some support at the wedge or we do a breakdown. So for now, if the price actually does a breakdown, we could be looking at about entering the support zone about $30.90 to about $36.40 area over here. So that could represent a downside of maybe about 25% from current price level at $41.36. If it does a bounce to to go back within the rising wedge itself. That could represent about 5% upside from current price level. Okay, so that's all for the US banks. Then I'll talk about the individual counters that I covered last week in the technical calls. So the first one is Capital DC REIT. So for this, we had a technical buy at $2.01, take profit level at $2.12. The stop loss can be placed at 196. The stock closed at 194 on Friday. So this trade was actually invalidated. So for Capital DC, we saw there was a potential continuation of this current uptrend, as it was actually trading in this uptrend channel over here, and there was a pullback that took place after it encountered resistance at the uptrend channel resistance. Then actually broke out of this possible bullish falling wedge formation with a bullish engulfing candlestick. However, it closed underneath it. So we are expecting that actually it could possibly go back to retest this $2.12 swing high level back over here. And then the next one will be Food Empire Holdings. So for this, we have a technical sell at 87 cents. We will take profit level at 82.5 cents. The stop loss can be placed at 90 cents, and the stock last closed at 85 cents on Friday. So for Food Empire, it's currently still in an uptrend over here in the uptrend channel, but there's a potential for a pullback in this current uptrend due to actually price actually moving up towards this channel resistance. So it was forming higher highs, but the indicator over here, the RSI indicator, was actually forming lower high. So we can see it's actually bearish divergence presence in this stock. So stock could actually pull back to the 82.5 cents level, which is this confluent with this swing high back in October 2021 over here. And that could actually touch onto the uptrend channel support as well. So for Food Empire, there's actually maybe some short-term weakness possible in this stock. So that's all from me for the technical analysis part. I'll now pass on my time to Paul to talk about Hyphens Pharma results.
Okay, thanks, Zin. Next slide. So for Hyphens Pharma, they released their second half results. So the results exceeded our expectations. I think revenue and PATMI was above our 100% of our forecast. So just a reminder. So for Hyphens Pharma, they are involved. They are a distributor of specialty pharma, but they are not the typical distributor where you get low margins. Their margins are much higher. I think 20 to 30%, and the reason is because they are exclusive and they sell mainly to doctors. So some of the specialty pharma products include, if you're having an X-ray, you need to there's a certain chemical you need to be used. So they are used in surgeries and so forth. So in terms of the positives, there was strong growth in specialty pharma. What we think is, so the EBITDA doubled to 7.9 million, as you can see from the table on the left. In part, this was because they made the acquisition end of last year, so you got a bit of a inorganic growth. But organically also the business did well because there was a reopening, and then because of reopening, hospitals enjoyed more elective surgeries and of course more visitations to hospitals and specialists. The negative is their proprietary brand. So for proprietary, what they sell is like Ocean Health. I think we all know that, the vitamins, and but the main one is also Ceradan, and their focus is on skin health. So for that, the margins were a bit lower. We think it's because they are undergoing product development costs as they were introducing new products into their lineup. In terms of the outlook, we expect a bit of slower growth because I don't think you can repeat the pent-up demand that they kind of enjoyed the last 12 months. But they still have new products lined up, like Nabota, Botox, and so forth. But what we think, this is more of a medium-term story for them. What they think is that Hyphens is building medium-term franchises. So one of the three franchises they're trying to build for longer-term growth is, number one, this is DocMed. So for those who may not be familiar, a couple months ago, they actually signed an agreement with Metro, the listed Metro, to build this platform. So this platform is, you can think of them like a Lazada, a platform for doctors, drug companies, and other healthcare providers. So when clinics want, so this is a platform where if clinics want to buy drugs and so forth, they can just go to this channel, or where doctors will be. So it will be a way to directly get connected to doctors. And so of course, you don't see that now. Mostly what we see is like only B2C and so forth. They can do that because if you look at the table, they have a medical hypermart, which is pan which they have been in this business for more than 20 plus years, which is not what they do. Is normally they sell drugs and so forth to all the general GPs around the whole of Singapore. The other second thing is, of course, like we highlighted proprietary brands. So this is another pillar, medium-term growth pillar that they're looking at, is to continue to build up the branding, the brand name Ceradan, which is used for eczema and so forth, and TDF and Ocean Health. And Novem was the acquisition. Novem is for them to penetrate the government sector. So they are very strong in private hospitals, but public hospitals, they are not that strong in that channel. So they can use Novem as to build a new channel for them. We maintain a buy, we raise our earnings, and And the only near-term headwind is that the last row of sentence is that because they are building this platform, so we think there will be a few $100,000 of extra costs that they're going to incur to build this platform. Obviously, they can strip it off and say it's one-off, but this will weigh down on earnings, which is one of the headwinds for them in the very near term. Next slide. So for Q&M, next slide. So what has happened is that revenue met expectations, but the earnings was below. So they face a drop, 10% drop in revenue because they no longer have the PCR test revenue, obviously. But the core dental revenue was flat, about 46 million in the fourth quarter. So the positive is that they still expanded the number of clinics. So for 2022, they increased by 16 clinics, almost one every month. Yeah. The profitability for the core, you will notice it jumped a lot, like it 100 from 1.6 to 3 million. Or actually it's doubled, not tripled. But what actually happened is because there was a bit of a change in the way they account for bonus. So it's not like they grew so much, just a bit of accounting treatment. That's why year on year is so high. The negative is that the issue for them was that because they increased the number of clinics so much, the revenue per clinic was actually down if we did an estimate. So one of the reasons is because the new clinics haven't reached maturity. There was also some disruptions to the clinics because they're having some nurse shortages, and also the reopening of borders actually dampened the visitations. So what they said was because of the reopening of borders, most of the patients didn't spend much time here, and then they didn't spend much on dental. I guess at least on the high end, or maybe they went overseas to have their dental treatment. So for FY23, the outlook, the top priority for them is to raise the utilization of existing clinics. So they have aggressively expanded the number of clinics. So every 2 months, they actually open roughly about 3 clinics. And so I think now they need to stabilize. So what they're looking for is volume to raise the visitations and the revenue intensity. Revenue intensity is just a fancier word to say increase the pricing. So to increase volume, they are still recruiting lots of doctors, I think, dentists, sorry. So for this year, they recruited, the last few months, they did recruit almost 20-30 dentists, which they were used to fill up the existing clinics. Then the revenue intensity is that they need to upgrade the skills for the existing doctors because they believe the dentists can scale up and do more complicated cases. Then they are also the last part of the outlook is that they are pursuing an AI-guided dental software. So for those who may not have heard this before, so what they're doing is that when the patient goes into a clinic, most times dentists have the recommended procedure can vary. Sometimes it may depend on their own particular skill set. So with this software, they call it ethical based. So what it means is that based on the findings of all the doctors and based on the database, based on the historically what is the best procedure, this software will recommend to the patient what is the best procedure for this particular patient. and most likely the doctors have to follow. So this is the kind of software that they're looking at. But the downside of this is that they had to incur expenses to build up. So there was, I think, 1 to 2 million of R&D expense this year, and it will continue to next year to build up the software. So we maintain a buy, we lower the target price, and we value it at 25 times PE, which is in line with peers. Next slide. So I'll just do this is our last portion. We'll just do on the Singapore Weekly. For Singapore macro news, we continue to receive a lot of tourists. So we had like almost 1 million in February, similar to January, about 900,000. Year on year compared to January last year, we're like, I don't know, 13 times or more. So because it was shut down. So the good thing is that Singapore continued to enjoy lots of visitations, and it's still only 60% of pre-pandemic. So there's a huge room to recover for the hospitality sector, which is really hitting record room rates. The other thing is SBS Rail. So this is SBS Transit Rail. So the number of passengers, again, because of the reopening, is still growing about 51%, and it's already back to pre-pandemic levels. It's like flat to pre-pandemic. So people going to trains have actually returned very fast. In terms of the jobs data that you saw in the headlines, of course, before the Silicon Valley headlines, so the US employment was very robust, about 300,000 compared to expectation of 200,000+. The only negatives there was that, which maybe negative these days can be a positive too, is that the unemployment rate actually went up a little bit. And to take into context, most of the job gains that you see in the US is partly due to the reopening. So the sustainability also can be questioned in the sense that the number of jobs added for leisure and hospitality was about 100,000. And this is 3 times more than pre-pandemic. So usually before pandemic, leisure hospitality, which is hotels, restaurants, usually only add 30,000 a month. But because of reopening, you're getting this big spike. So obviously this should normalize, and what we do see is the good sectors job additions is slowing down. So it's a bit of a mixed picture for the jobs. It's not like totally showing that the US is overheating. So in terms of our tactical views for the Silicon Valley collapse, so the main message is that the Fed is unlikely to either not raise rates, or even if they do, they'll raise it at definitely 25 basis points, and they might have to cap it somewhere, because if they keep raising, this might spread the contagion, because every bank holds all these government bonds and mortgages. And you can see the contagion spreading very fast. Within the next day, after 2 days of Silicon Valley Bank collapse, there was a second bank that collapsed in the US, a Signature Bank. So the key distinction here is that this is not a credit event. This is not like in global financial crisis where housing loans, the borrowers cannot pay. This was they bought a lot of government bonds, and then the whole portfolio collapsed, and then all the depositors just ran away. So that was the nutshell. So although the US government has guaranteed that they will repay the deposits, there will be still some contagion. Not as bad as not guaranteeing the depositor would be a calamity, but the contagion is that, of course, the equity will be wiped out. There's still about, I think, 17 billion of loans lent to Silicon Valley Bank. So those could also be wiped out. And the other contagion is that there's about 70 billion of loans that Silicon Valley lent out. So you're not sure whether they're going to refinance them. So if you borrow money from Silicon Valley, so the issue is, will Silicon Valley refinance? So there's still a little bit of contagion, but not as bad as the 150 plus deposits that disappeared, that will not be repaid. So for us, we think any selling in Singapore banks is an opportunity, like what Glenn mentioned. The two key distinct difference is that, number one, Singapore banks also had all these mark-to-market losses. So we also had losses in the bonds, but because most of our assets is actually to loans, and loans, when interest rates increase, you can pass on the higher interest rates, which is to all of us. I think if you have mortgages, you would realize. So because the banks actually can charge higher, whereas if you own bonds, you cannot, because you're stuck with the low interest rates. And the second thing is the deposits surge up very sharply, and the quality of deposits is hard to determine. But when you see such a sharp spike, then it may show that they also might flee faster. Then, of course, Singapore-based REITs will be a tactical beneficiary, because it means that the Fed will have to cap the ability, because now there's a systemic issue they have to worry about. If they keep raising rates, then this weakness in bonds can spread across more banks. So this is something that they have to consider now, which is not just about inflation. It's also the whole systemic risk for the whole banking sector in the US. The one other notable thing to note is that if Japan were to raise rates, I'm not sure when, but because now it's zero, right? So if Japan really were to raise rates, then we're not sure how this is going to impact the Japanese banks too, because they will also own a lot of government bonds. So in terms of the key events for this week will be the CPI on the 14th tomorrow. So that's another important news. We think because they're comparing the February, and February was the peak of the energy prices, we think CPI will still continue to drop, because all the real-time data still shows inflation dropping in the US. We also have webinars tomorrow and Viral Hub if you want to get an update on the rubber sector and so forth. Yeah, thanks. Next slide. Okay, so this is just my last slide, just to explain to everyone what happened. Sorry if you already know, so it's all over the news, but I thought this was just important to explain. So in 2019, you look at this table, in 2019, Silicon Bank had about 62 billion of deposits, and then they had investment securities, about 28, then they lend money, like a normal bank. I mean, like then they had loans of 33 billion. So the problem is that over the last 3 years, they collected 111 billion of extra deposits because the whole venture capital ran amok. There was so much money being put into all these startups. Then all these startups put their money with SVB. Then they actually did the right thing. They collected 111 billion of deposits. So they didn't. So most of it, they actually did the right thing and they put it into the most liquid and the safest assets, which is government bonds and government mortgage-backed securities, which is your Fannie and Ginnie Mae, which is also government-backed. But the problem is that when interest rates spike up, this 117 value collapse. I think almost 20 billion, more than that. But anyway, they sold some, then they had to take up the 2 billion loss, then they had to raise money. So they actually did the right thing, but the problem was interest rates just jumped up too much and the whole portfolio collapsed, and all these 173 billion disappeared, and they only had 14 billion of cash. And like on 9 March, they had like 42 billion of people trying to withdraw. So they just didn't have enough money to cater. So, but you can see the speed of the contagion. Then on the 12th March, now on this chart, you can see that another bank also collapsed because people just withdrew. Okay, yeah, I think that's it. I think we can move on to Q&A.
Yeah. Yeah, thanks, Bo. I think I'll take some of the Q&A, quite a few questions on the SVB, I think. Okay. Let me go to the first question first. Okay, so what's the expected fallout in Singapore market in view of the collapse of these small US banks? Okay, so SVB isn't very small to begin with, but yeah, I get your point. So for the SG market, I'll just speak on the finance sector first before I move on. I think this also answers quite a few other questions regarding the SVB. Let me just go through the other questions first. Okay, someone also asked, what about a summary of SVB versus Singapore banks, and how safe or conservative in comparison? Okay, so I'll answer these two questions. Firstly, I think I went through in my slides earlier, there are a few points differentiating SVB and what happened in SVB and how we are differ in Singapore. So the first point would be, of course, as Paul also mentioned, the large concentration on securities. So you would say that they're not as diversified. So Singapore banks are more diversified with quite a large sum in the loans. So they are concentrating on loans growth, which is what Singapore banks did. So it's safer in a sense where they can pass on the higher interest rates directly to the consumers. And the second one would, of course, be the growth of the deposits as well as the assets, which also hints at how the quality of SVB's deposits, in a sense that most of their deposits came from the tech sector and they have a lot of cash. So what happened was actually basically all the right conditions for the collapse. The rising interest rates resulted in the fall of their securities, and also the tech sector were unable to garner enough funds, and they had to withdraw from their bank, which was SVB, but they did not have the cash. So that was the perfect storm for the collapse. So in Singapore, the difference is that the demographics of the consumer base is not as just the tech sector. The demographics of Singapore banks are very diversified across all segments. So they have retail customers, they have SMEs, they have corporate customers as well. So that's the main difference, is that I think the Singapore banks are more diversified, and they also concentrate more on loans, which means that the higher interest rates will be able to pass on directly to the customers. So that speaks about their safety and conservativeness of Singapore banks. I hope that's a good enough summary. And for the fallout, for Singapore banks, I think yes, there's definitely a hit to the share prices for all three banks. I think that is to be expected, but I don't think there would be much of a fallout in the Singapore market, at least for the finance side. I'll leave it to the rest of my colleagues regarding the other segments which they all cover. Okay, one of the questions asks, is it time to scoop up some UOB or OCBC? Our target price is maintained for all three banks actually, DBS, UOB, and OCBC. So I think for UOB, the main narrative for both UOB, for all three banks, for UOB, OCBC, and DBS, will be that the NIM guidance has sort of slowed down a bit. So they are all guiding for a slight increase in the full year 23. But this would mean we are expecting a higher increase in the first half of 23, but a sort of a slowdown in the NIMs as well as the net interest income in the second half. So this would sort of moderate to a more normal growth for net interest income as well as net interest margins. But the main selling point would be the net fee income. So fee income is expected to grow by at least above 10% for all three banks. And this is mainly coming from a very low base in FY22 and sort of a recovery in the markets as well as China's reopening, which would boost wealth management fee income. Yeah. Okay, now moving on to the next question. Someone asked, thanks for explaining the difference between SVB and SG Banks. Apparently the shockwave was being felt by SG Banks share price also. Do you see this as a good buying opportunity for the shares? Yeah, so I think as I mentioned earlier, our share price is maintained, and we feel that going into FY23, they would be able to grow further with the comeback in recovery in fee income as well as the continued growth in their net interest income. Okay, maybe there's one about the Credit Suisse. Sorry, we don't cover Credit Suisse, but maybe I'll work on this and I can come up with some comments. If anything, do just scan this QR code here and join our Poems group, and you can put your question there, and I will try my best to answer as soon as possible. Okay, I'll hand it over to the rest of my colleagues first. Yeah, thanks.
Thanks, Ken. So I have one question here that says, what is the digital advertising vertical? So I guess the easiest answer is companies that are in the digital advertising industry. For example, Meta and Alphabet. These would be in your digital advertising vertical. So if you think about it from travel and hospitality, it'd be all your maybe Airbnb, Booking.com, and some of your resorts. But in terms of digital advertising, the main two guys or three guys would be Meta, Alphabet, and I guess Twitter and stuff like that. Yeah. Thank you. That's all for me.
Okay, we'll try to answer this few, then we can hand over to the technical part. Oh, what happened to my? Oh, sorry for my camera. Okay. Which other banks own a lot of US Treasuries as a 2%? I think this one Glenn might need to do a filtering. So we don't have the number right now. So this one we have to work on it. Yeah. So we don't have it offhand now. Then the next one is the next one I think will be for Glenn. I will just answer this one. Then we can have what is the expected fallout in Singapore market in view of the collapse? I think it's more sentiment driven. If the deposits wasn't protected, then there might be some indirect fallout. But again, this one is very US centric, and actually, it might be beneficial for the Singapore market because in a way, we might go back to the soft landing story because now it's back to hard landing. We might go back to the soft landing sentiment because I don't think the Fed can raise as much rates as before. Yeah, so I think it's more like a better a more positive thing in terms of the interest rate front that the Fed is going to be capped in how much more rates he can move. What is your view on SETS both fundamentally and technically? Okay, I think when they announced the acquisition, there was more details about the target, and apparently Terence not with us, so we don't have an active analyst now. Apparently the debt levels at SETS was much higher than expected. The other thing we worry is that usually in an integration, there's usually a lot more costs to be cut. I mean, you don't merge and don't cut costs. So that is our other concern for SETS. And again, SETS, you're just buying it mainly like SIA, just buying it for the whole recovery. So but yeah, so I just think that this stock will be probably going to be range bound, or if not weaker, because there isn't any improvement they get, they probably spend most of the time trying to do the merger. So we're just worried how well the merger will be done. I think technically, I think we can leave it to Zain. Okay, let me try and finish everything. I can just pass it off to Zain. Any view on any update on the Monty going forward? Yeah, the results was much lower than expected. We're still haven't completed the report. But it's definitely below our expectations. I think it's pretty obvious if you look at the results. The brand hasn't been affected. What we see the brand is that they still maintain their strong market share, 90%. But what disappointed was the festive season, especially in the Philippines. Because the festive season, the big margin driver for them is when they sell fresh pineapple to China. So the demand didn't happen. I think there was very big demand from China, number one. Number two, was also the demand in Philippines for canned tropical fruits, because this is a bit more discretionary, didn't happen. So the first reason for the weakness is the festive season was weak. The second reason was that, which was a surprise to me too, was that the margins in the US dropped quite significantly, and because a lot of because the inventory that they had was higher price than before. So I thought that most of their raw material, because the margins was very strong in the previous quarter, then it dropped, mainly because the inventory on hand was more or less replenished with a higher price inventory. So they didn't flush out. So I thought the flow through of higher materials would have been faster, but it didn't. So they are only now refreshing some of the higher price. So the margins got hit. And the third thing is that because sales disappointed, they are still holding quite a lot of inventory. So that is my worry for them, is that they still have a lot of inventory as they exit out of this quarter. The brands are still strong. No issue with the brands, but there were these few things, short-term things that hit them for these results. But we will give you an update in the next. Our report will be out in the next 1-2 days. Just that with the silicon thing, we didn't have much time. I didn't have much time to do it, to complete it. With the US hitting debt ceiling, okay, this one I'll let Sean handle it. Okay, thanks. So Sean and Glenn can take on the questions. Yeah, then we can move on to technical.
Yeah. Thanks, Paul. Okay, I think there's one more question for me. Yeah, it's a very good question. Hold on, let me just see if any more questions. Okay, yeah, there's one very good question. Yeah, so he asked, how about deposits with foreign banks in Singapore, based in Singapore. So it's like Citibank, Stanchart, HSBC. Are there statistics, figures for them, and are they safe, and how do they compare with Singapore banks? So yes, so basically if you look at their balance sheet, at least for, I'm just looking at HSBC and Citibank, the proportion of securities which they have is also similar to Singapore banks. So around, I think, if I'm not wrong, it's 20%. So the amount of securities is 20%. So they're quite diversified as well, because these banks are more like, I would say, in other words, they're more normal, ordinary banks. So they're servicing sort of retail clients as well as SME and corporates. So SAB is a very special case. They were serving mainly tech clients, tech customers, and corporates. So these three banks are quite similar to the Singapore banks, and so their assets are quite diversified, with around 20% in securities. And just one of the points I'd like to bring up, which I also covered earlier in my report and the presentation earlier, would be that this liquidity coverage ratio, which is a requirement by the central banks. So MAS requires this of all banks. So the three you named, and as well as the three local banks, they're all required to have at least minimum 100% liquidity coverage ratio. However, if you look at the case of SVB, because they fell below the minimum requirement, so they were not required to report their LCR, which is the liquidity coverage ratio, and they were not required to meet the minimum 100%. So nobody knew what was their LCR. But in Singapore, if you look at the foreign banks, they are all mandated by MAS to meet this requirement. Yeah, so that would show the sort of the safety for foreign banks based in Singapore as well. Okay, I think I'll hand it over to Sean for the question about the bonds.
Okay, regarding the bonds question, I'll get back to you later. Is it possible if Zane can take on the TA first?
Yeah, sure. Let me just start sharing my screen. Okay, so the first one I see is UOL. So UOL is still continuing on from its bearish movement over here. Looks like we have touched the 61.8% retracement level at $6.40, which is also a swing low over here in November of last year. Today currently is forming a spinning top over here for now. So let's see whether how it closes, whether there's some buying support coming in soon. For now over here, there could be a support, some support over here if the swing over here is supported and the 61.8% level holds. Then the near-term resistance probably be around 650 to about 660 over here, which is the 50% retracement level, and also based on the swing lows of generated in the start of December and January of this year. If it does if the pullback actually continues, we might be looking at for maybe 620. 670 will be touching this longer term trendline support over here that spans back to 2018, and then it's also a 78.6% retracement level over here. Then moving on to city developments. Okay, city developments, we have actually touched the uptrend channel support over here that dates back to 2020. So currently we are around $7.30. Over here there could be some support coming, given the fact that we also had a swing. It's also near a swing low, near at around October of last year over here. So this green color zone is the potential support zone to look out for over here. Resistance wise, the near term resistance probably around $7.60 over here, which was a swing low that was being broken which was a swing low in January this year that was being broken over here. Then moving on to Hong Kong Land. Okay, Hong Kong Land, we are facing resistance from this downtrend resistance line over here. Then we are still pulling back, and we have reached a 50% retracement level around $4.40 over here. So let's see whether some support comes in, which was a previous previous resistance swing high in November of last year. If the pullback actually continues, we might see maybe $4, close to $4.27, which is the 61.8% retracement level over here. Okay, then I'll move on to Hobby Land. On Hobby Land, I think we actually broke down a consolidation triangle wedge over here. Then we also broke a swing low that was at $2.25. That was a swing low of October of last year. So, and together we also broke 50% Fibonacci retracement level around $2.30. And we take the lows at the near $1.61, which was the COVID lows, and the highs at about $2.98. So the next support level to take note of probably be around, that could be around $2.13, $2.14, which is a 61.8% retracement level. And it was a previous high back in December 2019 over here as well. So that could be a next support coming in. For short-term resistance wise, probably be around 225 to about 233 over here. Okay, then moving on to Escort. Escort, after it broke down from this uptrend channel, last week we were just trading sideways. So some support was at $1, psychological support, as well as the range, previous consolidation range support over here at $1. So if this doesn't hold, we might be looking to maybe 97 cents over here, which is a previous strong resistance, horizontal resistance over here that could act as support if the $1 breaks. And for now, resistance is at around $1.03 over here to about $1.06 over here. Okay, next one, the CDL Hospitality Trust. So for this, so looking bearish for now. We actually broke below this uptrend support line. Then the near-term support could be near $1.15, $1.16, which is the swing low back in November of last year, and it's also a 50% retracement level when we take the lows at around 95.5 cents in October of last year and the highs at around $1.36 in February this year. So that possibly some more downside expected for CDL Hospitality Trust. And next one is Digital Core REIT. So for this one, it's actually looking quite bearish. First, the previous horizontal resistance level around 61 cents here failed to hold. Actually sideways for a while, then the bearish momentum actually continued. And then secondly, the downtrend resistance line over here also failed to support. Upon the retest, it failed to support. So we could be looking for some further downside to maybe the next trend line support over here. That probably might bring us back to maybe 51.5 cents over here. Or maybe even close to 50 cents, which is the swing low back in December of last year over here. Okay, then I'll move on to some Hong Kong ETFs. So this one is the 2801. So for this, we actually currently we are back in this downtrend channel over here. So there was a bounce last week, and then we subsequently re-entered back into this downtrend channel. For now, we are near the 50% retracement level. There could be some support near $19.63 over here. So then current resistance could be ranging from about $20.40, which was a swing low over here. We could do a retest over here to probably about maybe $21 over here. Okay, then 2800 Chapter Fund. So for this, we also we are also contained in this downtrend channel over here. We actually hit 38.2% retracement level at $19.74. We're actually currently doing a little bit of a bounce. So for this, a bit similar, the resistance probably might be $20, which is a swing over here, ranging to about $20.50 over here, which was a horizontal level that we broke down from. So if we do a further pullback, the next support level to look out for maybe is at close to $18.78, which is the 50% retracement level. And previously over here, there was a previous resistance also that turned into the support zone over here. Okay, then this one is the Hang Seng Tech ETF 3067. So for this also similar, we are continuing this downtrend channel over here. We touched the 50% retracement level for this around $7.90, and we're currently doing a rebound today. So if this support holds, the short-term near-term resistance could be around $8.30 over here to about $8.60 over here. Then if this doesn't hold, we could be looking at about maybe close to $7, closer to $7.38 over here, which is a 61% retracement level. The next one is Bitcoin. Okay, so for Bitcoin, actually, there was this broadening wedge, and then we actually broke down last week. Currently, it looks like we are doing a retest. So over here, upon the retest, there could be some resistance coming in around this 22,600 level to about maybe 23,100 level, which was a previous range support over here. Then we are also, looks like we're finding some support at near the 50% retracement mark, around the 20,300 level over here. But if we face the rejection and move further down, next level could be around 90,200, which is a 61.8% retracement level for Bitcoin. And then moving on to Hang Seng Index. Okay, Hang Seng Index, I think last week we had a bounce. We actually broke above this downtrend channel, right? Then we had a bounce to retest around close to 21,000. Interestingly, this 21,000 level is also this downtrend resistance line over here. So it looks like we find rejection over here. So until this downtrend resistance line is being broken convincingly, right? Still remains a possibility that this breakout over here was a false breakout. So still some caution needed for Hang Seng Index, I guess. For now, we are finding some support around the 19,000, near 19,300, which was a previous key horizontal level over here, given that it was a support back in May of last year and August of last year as well. Currently, today we are doing a rebound. So for now, some resistance could be near these swing lows at the start of March, which is around the 20,000 level over here, then to maybe about 20,300 over here. If the pullback actually continues, the next level we should look out for is possibly closer to 18,600 level, 650 level, which is the 50% retracement level. Then back over here, we also saw there was some support in December last year over here. Next one is Hang Seng. Okay, for Hang Seng Tech, looks like we are in this wedge over here. So we actually touched the 50% retracement level around 3,772 last Friday. Currently, we are rebounding from here. So short support looks like is possibly this level. Then resistance wise, we could be looking at maybe 4,000, could be near 4,000 to about 4,100 for now over here, which was the swing lows that we actually broke during this pullback. The next one is OCBC. So for OCBC, we actually broke down this, there was this rising wedge pattern over here that we broke down, and currently looks like we are trading in downtrend channel. Currently, there might be some support at around the $12, near $12.20 level. So this being the channel support over here, as well as we also tapped into this previous range support over here. So this was a support back in December of last year over here. So if this level holds, you might be able to see short-term bounce in OCBC. Then the near-term resistance probably be at around close to the $12.40, 50 cents level over here, which is the range resistance, as well as this swing low that we broke down off. Further pullback, if we do a further pullback, we could be looking at the next level of closer to $11.90 level, which is a previous swing low back in November of last year. And then also here we see it was a previous key resistance as well. So this is a key level to watch out for. Okay, then for sets, we actually retested a key swing low around $2.40. So this was a prior double bottom over here before we had a rally. So we came back to retest over here. Let's see how it closes today. If it still doesn't hold, the next level could be the lower wick of this candle around $2.35 over here. For now, the short-term resistance probably around near $2.50, which was this swing low over here that we actually broke down from, and it was a previous swing low support last time as well. Next one is a Mapletree Pan Asia commercial. So for this, we actually broke down this rising wedge pattern over here. So it's natural that we are seeing some bearish momentum setting in. So currently, we are actually tagged on the 50% retracement level at $1.66 over here. So over here, there might be some support coming if this level holds. If not, we might be going down to maybe near to $1.62, the 61.8% retracement level, which is also this previous swing low support over here that's a stronger support zone. So this was a previous support back in end of last year in December for Mapletree Pan Asia. Then resistance-wise, probably around close to $1.70 to about $1.73 if we were to retest the breakdown over here. Okay, then some more Hong Kong counters. So 3032, Hang Seng Investment Management Tech Index ETF. For this, we tag onto the 50% retracement mark already at $3.75. Currently, we are doing a bounce, so there could be some support at this level. Then resistance-wise could be around from maybe close to closer to $4 to about $4.10 over here. And the next support level, if this doesn't hold, we could be looking at about $3.50, the 61.8% retracement level. Okay, then for Tencent, Tencent actually finding some support around $332, which is the 38.2% retracement level. It's also still in this downtrend channel over here. So currently we are doing a bounce. So for now, resistance-wise could be around $3.55 to about $355 to around $360 over here, which is also the channel resistance over here. Okay, the next one is JD.com. So this one, we are still in this downtrend channel over here. And then we actually tag onto this previous swing low at around $164. That was in November of last year. And this is also a 70.8%, 78.6% retracement level for JD. So over here, if we get some support, we might actually do some bounce upwards. Then short-term resistance wise, probably around $175 over here, which is the channel resistance as well as a retest of this prior swing low over here. Then if further downside wise, we might be looking at possible retest of the lows near $139 over here, which was the lows in October of last year. Okay, then Ping An Insurance. So Ping An Insurance, we similar to Tencent, we are at the 30.2% retracement level. That's near $52. Currently, it looks like there's some support coming in. Then short-term resistance wise might be this $53 swing low that we broke down off, stretching to about $56 over here, which is the channel resistance over here. Then further downside could bring it near to maybe $48.20, which is the 50% retracement level over here. That could actually meet a channel support over here as well as the previous range support over here during December of last year. Okay, then next one is the Uni-Asia Group. For Uni-Asia, looks like we had a bounce recently, and it looks like it was a retest of this big wedge breakdown over here. So we had resistance from this downtrend resistance line at around $1.06. Then we also had this uptrend channel formation. So if there's a breakdown, we might be expecting some downside coming. Then the next support level to take note will probably be near this level around 94 cents, which is this previous swing low support over here back in June to July of last year. The next one is Yangtze Shipbuilding. So for this, is currently trading an uptrend channel for now. So today we tag onto the channel support around $1.28 currently. Then it's also this short near-term swing low over here. So we might be able to see a bounce if this holds. Then short-term resistance wise, I think it's from around 133 to about 136 over here. But if this fails, right, then we might be looking to the next level, maybe around $1.24 over here, which is another swing low over here. Okay, next one is AEM. So AEM looks like we retested the downtrend channel that we've broken down from today. So over here, there might be some resistance around 293 based on this previous channel support over here. But if we manage to go back above, the next resistance could be near $3, which is the previous swing low over here that we broke down off. Then for now, some support maybe if it holds at this level, probably 289, which is this horizontal level that we broke out from. Then going lower than that, probably be this trendline support. That might bring us to maybe $2.80 if we actually pull back. Next one is ST Engineering. So this one actually still remaining quite weak. I actually broke down this main uptrend channel and still trading in a downtrend channel over here. Looks like the 50% retracement level at $3.44 is failed to hold. So you might be expecting some further downside, reach the 61.8% retracement level. That's near $3.35. So that will be confluent with a swing lows generated over here as well in December of last year. So we might be expecting some support coming maybe at $3.30 to about $3.35 over here. The next one is Olam. So Olam, So we reached, after we broke out this $1.63 resistance level, then we reached a high of near 171, which was a previous high over here. So there was some resistance. Then we actually pulled back. Currently looks like we are under this uptrend channel again. So, and also under this $1.63 resistance key level as well. So if we are unable to go back above, then we might be seeing some pullback for Olam. Then could be retesting this swing lows around $1.52 over here. The next one is Best World. So Best World, I think we're still consolidating in this falling wedge pattern over here. So for now, resistance wise could be around $2.30 over here, which is the swing highs, and then as well as this wedge resistance. Then support could be near, for now could be nearer to $2.15 over here, which is the swing low support. Then if you go down to touch the wedge support, probably near $2.10. So it's prop next. Okay, prop next. We actually broke out of this downtrend resistance line convincingly after the results. Then we actually consolidated in the wedge bullish pattern, but unfortunately looks like there was a breakdown at place. So for now, the near-term, short-term resistance probably be near $1.89 to about $1.90. Then the support levels are to watch at $1.79, which was a previous high over here in March last year. Then the next stronger support level will probably be around $1.75, which is this horizontal level that we broke out of over here. And next one is Thomson Medical. Okay, Thomson Medical, we actually had a breakout of this downtrend resistance line over here. Then currently it looks like we are successfully retesting it over here. So short-term resistance wise, probably around 0.079 to about 0.081 over here based on this resistance, previous resistance. Then if we are able to go higher, then the next level probably around 0.084 over here, based on the resistance here and the previous swing high over here in April of last year. Okay, next one is Genting. I think Genting looks like we actually retested this channel support after we actually sideways and did a breakout over here. Then we reached about $1.06, but we came down back over here. So for now, it looks like a retest of the previous resistance and Northern support at $1.02. Then short-term resistance wise will be this recent highs at $1.05 to $1.06. If we go down further, if this fails to hold, we might be able to retest this 97.5 cents to about 99 cents to support levels. I think for Genting, there's some bearish divergence possible as well. Because since it made a higher high in the process, but the MACD actually made a lower high. And today we see a first bearish crossover as well. So that might be something to take note of for this stock. Okay, then the next one is UMS. Okay, UMS, I think we're still currently looks like it's just sideways for now with some support at $1.01. But it's still trading below this downtrend channel over here. So short-term resistance wise, it will be at $1.05 to $1.06 over here. Then if we go down, a little bit further, if this $1.01 level breaks, or we might be looking at $1 over here and possibly filling the gap over here at around 97 cents. If some further downside want to show up. Okay, the next one is venture. So venture, I think we are sort of consolidating for now. Possibly in this descending triangle pattern over here. This was after we touched this level around $16.87, which is a previous support over here in December of last year, and it's also a 61% retracement level. So over here we see whether what's the next move gonna be. If it breaks down, the next support level to note will probably be around near $16.40. If it breaks up, the near-term resistance will be around $17.40 over here. Okay, then Sembcorp Industries. I think Sembcorp still moving pretty well, holding up pretty well despite the recent weakness in the index. So we retested the swing high over here at $3.83. It's still trading an uptrend channel. So over here, if we see a breakout, we might be able to see further upside to maybe near close to $4. Could be the channel resistance over here as well as a psychological level. Then short-term support-wise, in the channel-wise, probably be around $3.73 over here. Okay, then SGX. SGX, we are trading in this downward sloping channel over here. We actually retested a previous swing low support around $9 over here that turned into resistance and currently pulling back. So for now, short-term support-wise, I would say around near $8.60, possibly a retest of the recent lows as well as the channel support over here. Then if you do break down the next level to watch out for, probably near $8.44 over here, which was a previous key horizontal level over here. Okay, this one is CIFMAC. Okay, CIFMAC recently looks like we did a double top over here of the previous high around 73 cents back in 2021. So currently after we did that, we are currently pulling back. So for the pullback, I think some support might be coming in near 67 cents, which was a previous high over here during this consolidation range back in February over here. Then there was a previous resistance high in October 2021 as well. A deeper pullback possibly might bring us back to near 65 cents, which is the lows of this range consolidation, as well as a previous horizontal resistance, key horizontal resistance over here for this. Then short-term resistance will probably be around 70 cents to about 71 cents over here. Next one is Prime. I think Prime, looks like we failed to actually backtest this downtrend breakout successfully. So could be looking at some further downside also, given that we actually broke below this 38 cents level, which was also a previous low back last time in 2020. So we could be looking at a retest of this lows around near 34 cents over here. Then resistance wise, probably around 38 cents to about 40 cents over here. Okay, then Lion OCBC HST ETF. So for this, we actually pull back to the 50% mark. So that's at the 63 cents level. So over here, we are seeing some bounce today. So for now, resistance wise, based on this swing low that was being broken, it's around 66 cents. Then we move further up based on the swing low that was being broken last week. Resistance probably around 68 cents over here. That could possibly be the confirming the channel resistance over here as well. Then if we were to see further pullback wise, the next support level to take note probably be near 60 cents. 61.8% retracement level, then confirmed the swing lows over here in end November last year. Next one, ESR logos REIT. Okay, for ESR logos, generally the long-term view is still trading in a downtrend over here. Then, but recently it's just sideways for now. Resistance-wise is seen around 33.5 cents to about 34 cents over here. Previous support that was being broken into resistance. For now, there's some support at around 32 cents, which was a previous low over here. But if this level doesn't hold, we could be looking to maybe retest another low near 30 cents over here for ESR. Next one is the TA for capital. Okay, I think the overall trend is definitely in an uptrend over here, but we are near the resistance of this uptrend channel. Currently, we just sideways for now. So resistance wise, I would say probably around close to $5.55 to about $5.60 over here. Support wise, we are seeing it around close to $5.40. If this is broken, the support will probably go down to possibly $5.15 to about $5.25 over here. Then if the lows of this candle is being broken, we might be looking to fill this gap over here for capital. Yeah. On this one, China Aviation. For this one, looks like the uptrend support line was being broken last week. So this was at around 95 cents level. So we are retesting this line, this downtrend resistance line that we broke out of. So currently we see whether we get some support over here at the 90 cents level. If we do, then we might be able to see a bounce coming in. Then short-term resistance will be around 97 cents over here. If we fail, then we might go on to the next retracement level near 87 cents, the 3% mark, which was also confirmed with the previous consolidation swing lows over here in December for China Aviation. Okay, for micro mechanics, we are still trading at near the lows of this falling wedge over here. So there might be some support near $2.08, given that this is also a 61.8% retracement level and a previous resistance high in 2020. But if this fails to hold, I see the next support level possibly being at close to $1.93 over here, which is the consolidation lows last time back in September 2020. Then for now, current resistance probably be at around $2.17 previous low, and then we see upon the retest over here, there's some resistance coming. Okay, Salesforce. Okay, Salesforce actually, after the result, we tapped up at the resistance area around $193, and we have been pulling back. We actually broke below this uptrend channel also as well. So over here, if we continue to pull back wise, we might be looking to fill a gap over here. So the support probably be around $165 to $168 over here. Then short near-term resistance wise probably be around $178 over here, which is a channel support that was being broken, and then the previous swing high over here. The next one is a Jardine CNC. We actually broke down below this uptrend channel over here. So we might be looking to retest the lows around here near $27.50 level. Then for now, resistance wise, probably ranging from 2880 to about 2950 over here. And for Hoppa, I think actually we tested this previous strong resistance, horizontal resistance level here around $9.80. Actually overshot a little bit, but let's see whether we're able to find some support over here. If we can't, then we might be looking at the next strong support level around $9.30 over here. Yeah. Then for now, short-term resistance wise, probably around $10 over here. Okay, then come to the DBS and UOB. Okay, for DBS, we are still in this downtrend channel over here. We are near the 50% retracement level, near $32.60 over here. That might be a first level of support to take note. Then the next level is $31.70, which is a 61% retracement level. Then over here, we see it was also confluent with the previous range support over here as well. So that might be a strong support to take note for DBS. Then for now, short-term resistance-wise, probably be around $33.50. This swing low that we actually broke down from, and it was a previous swing low over here as well. Then for UOB, we are actually near the 61% retracement level, near $20, also a psychological number. Then over here, last time, there was some previous resistance over here as well during the consolidation over here. So if we do retest this level, there could be some support. I mean, near $27.70 to about $28 over here. Then near term resistance probably be around maybe $29 to about $29.20 over here for UOB. Okay, then move on to Singtel. Okay, for Singtel, I think we are just range trading for now. So still finding some support near this support zone of $2.30 to about $2.35 over here. Then resistance is still $2.43 based on this support that we actually broke down from. So I still think that the range trading probably going to continue ahead. Okay, for Hong Kong Exchange, I think we have faced possibly some range trading for now. I think if the lows over here at 311, 312 is able to hold, last week we tested this resistance level at 344, 345, we pull back over here. Currently, we are retesting the lows over here at around 317 over here. So you might be actually caught up in this range over here. So then the middle level is at 330. So that might actually continue unless we actually break below this recent swing low. Then we might be looking at maybe the next level, maybe near $293, the 50% retracement mark. The next one is Alibaba. Alibaba still in downtrend channel over here. So today, last week and today, we actually tagged onto a 68% retracement level. That's at $82.50. Then over here we see some support coming in. Then this was also a previous range support as well during December of last year. So over here we might be able to see a bounce up to maybe retest this channel resistance that's near 89, possibly at near $89 to $92, this recent swing high over here. Okay, for capital net invest, I think rather weak for now, given that actually still continuing its downtrend after breaking down of this uptrend channel over here. So we actually filled this gap over here, and we are actually near 61.8% retracement level, near $3.39. So over here, it was a previous short-term support as well. So this could be a key horizontal level to take note of if some support actually generates over here. Yeah, then short-term resistance-wise, I would think it's possibly at around $3.50 to about $3.55 over here. Based on this opening price of the gap up over here that we broke down off, and $3.55 over here was a previous swing low as well. Okay, here is a Thai bear. Okay, Thai bear, I think we are just still range trading over here. The support is around 62 cents over here. So this is 62.5 cents. So this was also a 50% retracement level over here that we see a bounce over here. So if this level is able to hold, I think we might continue to see a range trade over here with the resistance near 65.5 cents to 66 cents. But if this level gives way, then we might be looking at lower level near 60 cents to 60.5 cents, which is a 61.8% retracement level. Then over here, this was a previous there was a previous horizontal support over here as well at this level. That is a golden agri. So golden agri, we actually retested the previous resistance around 29.5 cents over here. Then we actually just put back again. So looks like we might be seeing some support at around maybe 26 cents to about 26.5 cents. This previous range of resistance level over here. Yeah. Then for now, short-term resistance will be around 27.5 cents to 28 cents over here, which is also this downtrend resistance line over here as well. The next one is a public bank. For public bank, I think that we are in this like a descending wedge pattern over here. So for now, there is some support over here near the $4 mark. We're getting it from this trend line support over here. And meanwhile, resistance probably be near $4. Sorry, we get $3.95 is the support. Then the resistance over here is around $4.05 over here, which is also this trend line resistance over here. Then when using the swing low over here around $3.66, which is the December swing lows, then this is near 61.8% retracement level over here. So if we manage to break out, then we might be able to see some form of upside to maybe retest $4.15, this recent swing highs over here. Next one is Jardine Matheson Holdings. So for this, it's still continuing its bearish momentum, still quite weak for now, given that it actually broke down this uptrend channel over here. So we actually broke below the 50% retracement mark at $40.75. So we might actually be heading to maybe nearer to the 61.8% level. That's near $47.30 over here. Then over here, we observed last time over here, there was some swing lows being generated over here as well. So support may be around $46 to about this $47.30 level. That might be a stronger support level for Jardine Matheson. Then resistance wise, I think will be ranging from about 48.70 to about 49.40, which is this swing low level that we broke down off recently. Okay, there's Capital REIT. Capital REIT is also quite weak. So we actually failed to hold at two levels. The first one being this 90 cents level, which was a previous resistance. It acted as support for a while, but it actually broke down below it. Then this trendline support at 89 cents also failed to hold. So for now, we are near this previous swing low support at around 85 cents. So we might be heading for some possible further downside to retest this level. Then the resistance will be this trendline support that we actually broke down from. So I think I'll just cover last question for me is, how reliable is bullish divergence for a counter? Is it 70% or 50-50? I would say if you're just looking at plainly just based on divergence alone, it's around 50-50. Then you should actually pair it with whether it occurred at a strong support or resistance area and possible other technical stuff like the trend lines or channels as well. That will actually increase the probability. Yeah, that's my view on it. So I think that's all from me for the technical part. I'll pass on my time back to my colleagues.
Thanks, Sim. So we have another couple of questions here, but unfortunately, Paul had a meeting to go to, so he wouldn't be able to answer any other questions. So with that, I think we'll just wrap up the end of the webinar. Thank you all for joining us today. And
so sorry, John. I think I answered the last question, the previous question about yeah.
Sorry, Sean. Go ahead.
Yeah. No worries. So regarding on the questions on with US debt ceiling hitting the ceiling in the mid 2023, should retail bondholders of USD be concerned? So US debt ceiling is more applicable for US Treasuries, and this limit was hit back in 19 January earlier this year. But for retail US bondholders, it is good to also be aware, because if the Congress do not raise its debt ceiling in due time, which is around mid this year, it could lead to a default on US government bonds, which would cause a significant decline in value for US bonds. However, the chances for US government bonds to default is possible, but very unlikely, as US government has always paid its debt on time and in full, prioritizing its debt payment over other government expenditures. So also a default in the US government bonds will have serious consequences for US economy and also the global financial markets. So, I mean, we have to keep a lookout on any addresses from the Congress. But from now till the June period, which is this time, I think they'll try to mention about any changes. But it's also good to have a diversity of bonds and not focus purely in the US landscape. So I hope that answers your questions. Yep, back to you, John.
Thanks, Sean. Yeah, so I guess we'll now end off the webinar. Thanks for joining us again. Hopefully, so if there are any more questions, please feel free to post it in our PhillipCapital's Mobile 3 community groups, and we'll try to answer it as soon as possible. Yeah, with that, thanks for joining us. We'll hope to see you guys next week again. Thank you. Bye-bye.